This is Chapter 16, Video 1. Let's launch. All right, everybody, welcome to corporate operations. This is what we all want to get into, right? Okay, so you became an accountant. You're kind of like, there's all this individual stuff. I don't want to deal with any of that stuff. That's boring. I want to get into something meaty and something exciting, corporation operations. So we're going to talk about that today. So today's video is going to be describe the corporate tax income formula and discuss tax considerations related to corporations, accounting periods, and accounting methods. That's all in one breath. Gosh, I'm getting too old. I don't have too much of that breath left, you know? So anyway, so corporate and individual tax formulas. Okay, so I love this slide. This is one of the things that when they brought it up, this makes sense to me because when I'm trying to figure out how corporate taxes work versus individual taxes, this slide really made sense to me. And if you're a visual learner, I'm generally not, but this is actually a slide that I really enjoyed. I tend to be an audio kinetic learner, but this is a slide that I think really kind of broke it out to me. And it also is interesting because oftentimes people begin to think that corporate tax, especially these corporate guys. Oh, I do corporate tax returns. They think they're like the, God's gift to they think they're God's gift to accounting. And that's not the case. The corporate tax returns are one flavor of it. Individual tax returns are another flavor of it. And obviously, each one of them has their value. But if you take a look at it, this is the way that they break it out: gross income, deductions, taxable income, tax rates, regular tax liability, other taxes, total taxes, credits, blah, blah, blah. So if you take a look at that and compare it to the individual, you're going to notice it's pretty much the same thing. The only thing that they don't have is the adjusted gross income. And then there's deductions that are for AGI or above the line deductions. And then they have deductions from AGI or below the line deductions. Corporations, they don't waste time with this. So financial income is often the starting point for computing taxable income. And that's true. So in generally speaking, the way income is recognized from a financial perspective is really going to harp and hit how income is recognized on a tax perspective. So especially if you're doing accrual accounting, oftentimes if you do accrual accounting for your tax payments, what it is for accrual accounting is pretty much going to be it for tax. I mean, it's not going to be one of those things that you can get out and say, well, yeah, blah, 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 unless there's a tax reason for them to exclude the income. For example, tax exempt bonds. You can do those as a corporation, and then you would end up being able to exclude that. But generally, financial income is going to be the starting point. You're going to reconcile the taxable income using some book to tax adjustments. And then there's going to be those differences that are going to be between financial rules and all that. And then the companies preparing financial statements with tax methods won't have book to tax adjustments. I've been doing this for a long time. You don't see too many people who prepare books on the tax rules. They think they do, they don't. And so what ends up happening is I actually fix them to financial, and then I bring them to the tax actually. By the way, before I go on to the next slide, I'm going to let you guys in on something. I'm going to actually provide to you guys a template that we can do a lot of these book to tax adjustments on. It's something I use in my firm. I've actually worked in a lot of firms that they buy fancy software that actually does all this stuff. We don't need that. Excel actually, if you set up Excel correctly and you do it right, you can actually do this, and it actually works out very well. It's a very logical process. It's a very sound process. I've used it at a couple smaller firms, and I'm just like, why doesn't everybody do this? And they're like, well, because they want to spend thousands of dollars on software they don't need. So that's actually a very big, important thing to know. I will give that to you. It will be at one of our meetings that we have, and I'll kind of talk a little bit about that. All right, so when we talk about book to tax differences, they're going to be broken up into favorable, unfavorable, permanent, and temporary. I hate this. I hate this wording, favorable, unfavorable, just because it kind of makes it, favorable to who? Okay, so the taxpayers got to pay more money, but it's because they did something that usually if they get this unfavorable, normally it's because of something, oftentimes unfavorable is going to be a temporary difference. There's a few permanents, like for example, penalties and interest on like delayed tax payments. In my opinion, you did something wrong. So yeah, it's going to be unfavorable to you, but don't do something wrong. Anyways. But I tend not to like these terms, but that's what the book does. That's what the industry does. And that's how they do this. And so, favorable, unfavorable, permanent and temporary, it is what it is. Interest income from municipal bonds, that's going to be a favorable expense, favorable change. Death benefit from life insurance, that's favorable. Again, I don't like to use the word favorable because, life death benefit, person's suffering already. Life insurance premiums are going to be unfavorable, meaning that you're going to pay them out and you're not going to get a deduction on them. That is actually a permanent one. 50% of meals, that's unfavorable. That is permanent. I guess those are a couple of other examples. Entertainment expenses, unfavorable. That's brand new. And again, the fines, penalties, and political contributions being unfavorable. Fines and penalties, I think, is pretty obvious. Political contributions, there's just been a lot of abuse in this area. And so that's one reason why they do this. And then the other thing is, now I will tell you, I think something that needs to be considered here, it may be an unfavorable change at the federal level, but it may not be at the state level. And that's actually the case more with individuals than it is with corporations. But like, for example, in the state of Virginia, you can actually make a contribution to the Democrat or the Republican Party and actually get a tax deduction off of it. It's actually one of the boxes you could check that says, I want to do this, blah, blah, blah. And they'll give you a tax deduction, but you can't take that tax deduction at the federal level, only at the state level. And so that's going to be kind of important. Federal income tax. Obviously, if you pay federal income tax, you don't get to deduct it for federal income tax. That'd be kind of ludicrous, create that circular reference we don't want to deal with. Dividends received deduction, favorable. We'll talk a little bit more about that later on. And then stock option expense from ISOs. So we call these ISOs in the field, or ISOs. More often than not, I've heard ISOs. ISOs have actually lost a lot of popularity. And the reason why is because they have a very, very nasty alternative minimum tax treatment. If you want to learn a little bit more about ISOs, I do have a video that I made for beta on this. And I talk about it. It's actually, I think it's a relatively short one. I don't think we got too much into it, but basically it's because of the alternative minimum tax treatment that, under the old rules, ISOs really, really, really got hurt bad because of the AMT treatment. Now that AMT has been phasing out and they've phased it up to the level of, so high that usually ISOs don't have the same problems that they did in the past, but they still have the corporate side. Right? So when you pay ISOs out, it is an unfavorable treatment on your tax return as far as a favorable, unfavorable difference. Stock option expense, when book expense is different than tax deduction, that's when you're going to have favorable, unfavorable. We don't talk about stock options here. It's a topic I love. So it is something I do find interesting. However, for the most part, this we don't do that. So that's kind of how that is. All right. So common temporary book to tax differences. Again, we're talking equity income. So for example, if you under the financial method of financial accounting, if you have more than 20% in a company, but less than 50%, you're going to use the equity method. That income that you receive from that, you're not going to pick that up in taxes because it's going to be tax once, tax at the source. So that company is going to pick it up on their books, but you're not going to pick it up on your books because that would be double taxation, and they don't do that with regards to this. Depreciation. So the way I depreciate things, remember, in financial accounting, it's an estimate. Under tax, it's hard, fast rules. So they're generally, this is probably the most common book to tax difference that I deal with every day, other than, meals. I'd say depreciation is probably the most common. Gain and loss on depreciation, sale of depreciable assets. Again, because depreciation differences are going to take place, you're going to have it to where your book income, your book computation is going to be different than your tax computation and all that stuff. Bad debt expense. With bad debt expense, you're going to have, again, the IRS requires direct write-off methods. and which I know is completely against GAAP. But the reason why they don't allow you to do this, there's just too much, too much potential for fraud, waste, and abuse. And so as a result of which, they say if you write it off, if you got charged income in a previous period and then you're no longer able to collect that debt, you can write it off in the subsequent year, but it's got to be the direct write-off method. So 263 Cap A, uniform inventory capitalization costs. That obviously, because it's an IRS regulation, it's going to be treated differently under book than tax. Organizational startup costs. Generally, financial accounting will do these very different, and so you got to know those differences. You don't see those very often. I mean, and when I've done them in the past, a lot of them just get directly written off on the financial side. Some of it you might capitalize up. But for the most part, organization and startup costs are treated very differently. We talked about that in one of the previous videos. Unearned rent revenue. So if I pay for rent up in advance under financial accounting, I get to recognize it over a period of time. However, as a tax, that's not the case. You have to be able to you have to recognize it when you get the cash, or you can do the deferment for 1 year, as we talked about in Chapter 9. Deferred compensation. That's a type of like for example, if I, very good example. If I come and I ask you to work for me, and I say, if you work for me, I'm going to pay you a salary, but I can't pay you a whole lot. But if you work for me, and 5 years later, I will cut you a check for $10,000. Okay, that's deferred compensation. The way that you're going to recognize it over financial accounting, you're going to recognize it over time because it's going to be, it's going to be recognized over time. But for tax purposes, you might not recognize it until it's actually pushed out. And then interest expense there could be some differences, especially because of the new interest rules that are in existence today. All right, non-qualified stock options. Again, we won't talk too much about that. Net capital losses. Carry back 3 years and forward 5. Financial is going to let you write off immediately, but you may have some issues where in the corporate accounting, tax accounting world, you may have it to where you don't have enough losses in order to be able to write off the income, or you have too many losses and you can't take it all in 1 year. Again, net capital losses, you can carry back 3. And the way that gets done, it can be done with an amended tax return, or there's actually a form that you can fill out. I can't remember the name of the form. The last time I filled one out was in 2012. So I haven't actually done one in a long time, but I know that there was a single form that can get filled out. It's like a simplified, because it's simplified for taking something from a previous, to a previous year like this. So, carry law, and in the IRC before, there were a lot of things that were able to be carried back. A lot of those have been phased out, and a lot of it's just carry forwards only. So you don't have to worry about it too much, but capital loss is still 3 years back, 5 forward. Net operating loss carry forward. They were trying to do it where you can only take 80% going forward, but then they moved it back to 100% because of under the CARES Act with the COVID pandemic. And so that actually affects things. And then goodwill acquired in an asset acquisition. Goodwill, of course, you're never going to write it off unless you test for impairment and it's impaired. Under financial, and then tax, we're going to take that and amortize it over 15 years. Dividends, including gross income for tax purposes, if received from a domestic corporation. So what'll end up happening is you will have what's called a DRD, a dividends received deduction. So if your stock ownership is less than 20%, dividends are included in book income. However, same as tax. However, unrealized gains or losses included back in book income is not recognized as taxable income. In other words, trading securities mark-to-market principles don't happen in tax. We don't mark to market. We only do it when the stock is sold. So it's a temporary difference, because when the stock's actually sold, you'll recognize the gains, but it will reverse when that stock is sold. So if ownership is at least 20%, but more than 50%, the receiving corporation reports its pro rata share of the distributing income method from the receiving corporation does not include dividend. I'm sorry, I'm trying to look around the camera as I'm doing that. So if it's greater than 50%, consolidated financial reporting, intercompany dividends are eliminated for book tax purposes. That's the financial rule. Corporations don't do this in tax rules until it gets to 80%, and so that's actually a big difference in the thing. Okay, folks, so that's all I got for this video. I want to say thank you very much, and I hope you guys learned something. If you have any questions, reach out to me, and I look forward to seeing you at the next video.